Let AI take care of the job of earning money.
Hi, everyone. Now let's introduce how to read candlestick charts. Our channel primarily focuses on sharing how to use AI for trading. It's perfect for beginners who know nothing about trading, or those who only have a basic understanding. We won't cover too many formulas or complex maths here. Our focus is entirely on practical, real-world application. And we definitely won't be sharing any so-called guaranteed winning strategies or secret formulas to make massive profits, because those kinds of things simply don't exist in the real world. If you are determined to find that mythical holy grail, honestly, there are plenty of other channels for that. Candlestick charts are so basic that many online finance gurus consider them unprofitable content, with little value or potential to attract views. Luckily, our channel's main focus is sharing valuable insights. If you are just here to make money or grab views, we'd be better off reading in models for silly antics or song and dance routines. It'll definitely be more profitable than covering this topic. The first thing to get right with candlestick charts is the color scheme. Everyone knows that candlestick charts are usually red and green. However, the colors commonly used in Chinese-speaking regions are actually the complete opposite of the international standard. In Chinese culture, red is seen as an auspicious color, so it typically represents a rise while green represents a fall. Internationally, though, it's almost the opposite. Red usually indicates a decline, and green signifies a rise. Since this channel focuses heavily on AR, which is more suited to forex trading and cryptocurrency, we'll stick with the international standard moving forward. Green represents a rise and red represents a fall. If everyone isn't aligned on the color standards, a momentary mix-up could lead to costly mistakes. Simply put, a candlestick chart is based on four numbers: the opening price, closing price, highest price, and lowest price. If the candlestick is rising, the color is green. From top to bottom, the levels represent the highest price, closing price, opening price, and lowest price. If it's red, then the opening and closing prices switch places. The prices of two consecutive candlesticks are always connected. The closing price of the previous candlestick always equals the opening price of the next one. If the closing price of the candlestick is higher than the opening price, the color will be green, otherwise it will be red. Many experts tell us that the focus of the candlestick should be on the opening and closing prices, and that the highest and lowest prices aren't as important. In terms of the chart, they emphasize the body of the candlestick over the wicks. However, we don't see it that way. The highest and lowest prices are also part of the price action. They represent actual prices that occurred within the time frame. For instance, if I'm looking at a 5-minute candlestick at 10 o'clock, the closing price reflects the price at that exact moment. However, within these 5 minutes, the highs and lows capture the price fluctuations, and these are just as valid as any other price data. In fact, if I switch to a 3-minute candlestick chart, the high of the 5-minute chart could very well be the closing price on the 3-minute chart. From another perspective, your take profit and stop loss levels aren't based on the opening or closing prices. As long as the set price is hit, even if it's the high or low of the candlestick, you'll be forced to exit the trade. If we look at just a single candlestick, what information can it provide us? A single candlestick can reveal the level of price consensus during that period. The simplest way to gauge this is by its color. Green or red indicates whether the consensus was bullish or bearish. However, this only holds true in markets with high trading volume. In low volume or lesser known market, the color can be easily manipulated. That's why we always advise against trading cryptocurrencies other than BTC and ETH. For smaller coins, price movements are often disconnected from true market dynamics, as just a few players can easily manipulate these niche markets. When a niche cryptocurrency shows a green candlestick, it's highly likely that this is the result of manipulation rather than genuine market forces. Take Taiwan government bonds, for example. Most of the trading is done by a few large domestic institutions, so it's not a market with many participants. Typically, about 6 months after a Taiwan government bond is issued, it often becomes neglected, with few trades in the market. If two players coordinate, one selling at a specific price and the other buying at that same price, a new price is effectively created through this arrangement. For many small regional stocks and dozens of minor cryptocurrencies, their prices are often the result of manipulation by large holders. Of course, if you had insider information, like knowing the movements of government funds, you could easily make a fortune. But if you rely on candlestick patterns or technical indicators alone, more likely, the market won't just show you a yellow or red card. It'll send you straight to the grave. Now let's take a look at how we can interpret the message a single candlestick's appearance is trying to convey to us. There are many guides on interpreting candlestick patterns, but they're often overly complicated, especially those that involve multiple candlesticks forming patterns, like the bullish engulfing morning star for free wax soldiers. It almost feels like they're teaching us some ancient martial arts secrets. These candlestick patterns are often highly subjective. If you want to enter a trade, you almost always find a pattern that justifies it. In cryptocurrency or forex, these candlestick patterns aren't usually as effective. The main reason is that these patterns originate from stock market analysis, where trading is typically done with spot assets, not leverage, and most analysis focuses on daily charts rather than 5 or 15-minute charts. In that longer time frame, patterns may indeed be more reliable. Let's clarify. Pattern analysis is absolutely a valuable method in technical analysis. However, if you are trading short-term cryptocurrency contracts or high-leverage forex, traditional patterns don't always perform as effectively in these fast-paced environments. Next, for any trade to occur, there must be someone willing to buy and someone willing to sell. This sounds obvious, almost like stating the obvious. But it's these basic principles that help us truly understand trading. If there's demand to buy 4 shares of Apple stock, but 5 shares available for sale, then either the 4 cheapest shares will be sold, or if the prices are identical, the shares listed for sale first will be the ones that get traded. This second scenario isn't visible on the candlestick chart. You might list a sale at $100 and the market even reaches that price, yet your order doesn't go through. This can be a frustrating and confusing experience, and it's actually quite common in the market. This is especially likely to happen when trading low liquidity, niche assets with minimal market activity. As for the first scenario, we can use candlestick charts to conduct some analysis. For a 5-minute candlestick, if a body is thick and the wicks are short, it indicates that investors had little price consensus during those 5 minutes. A lack of consensus is actually beneficial in trading, as it suggests a higher probability of future price volatility. A completely stagnant, lifeless market, where prices don't hit your take profit or stop loss levels, and just trap your capital while wasting your time, is every trader's nightmare. If a candlestick is short overall, with even the high and low points close together, you can interpret it as low volatility. Even if there has some difference between the high and low, if the opening and closing prices are close, it indicates strong consensus. When you encounter such lifeless candlesticks, our recommendation is to avoid entering the trade. But what exactly qualifies as a small high-low difference or is in candlestick body? This is highly subjective and the judgment varies significantly across different products. For a 5-minute Bitcoin candlestick, our usual standard is that if the range divided by the opening price is less than 0.15%, we consider it a low volatility candle. Similarly, if the difference between the opening and closing prices is less than 0.0%, we also deem the candlestick unsuitable for entry. Of course, this is just our preference. It doesn't mean your experience or perspective will be the same. Since AI trading is automated, You also need to design your own definitions of candlesticks that are unsuitable for entry. Another dreaded candlestick pattern is the spike, which can appear as a long wick pointing up, down, or both. It's notorious because wick spikes are often used by unscrupulous exchanges as a tactic. When these appear, they can easily trigger stop losses or, worse, lead to liquidations. For those interested in learning about the tactics used by unscrupulous exchanges, feel free to check out our previous videos. A spike refers to a candlestick pattern with a relatively small body, but an extremely distant high or low point, creating a long wick. Since the body of this candlestick is short, with price quickly reaching a high or low before bouncing back, it indicates a high probability of large capital entering at that moment. However, aside from that initial surge, the broader market didn't support that direction, causing the price to snap back to levels close to where it was before. Why would large capital want to make a quick move in the market? One possibility is that they feel the timing is right to start accumulating positions, gathering liquidity from the market to prepare for a shift that they can later profit from. Since large capital typically uses lower leverage, you need to follow their rhythm to seize these opportunities. But as you try to ride a trend backed by 5 times leverage with your own 20 times leverage, you are pushing the limits. Unless you have a main character advantage guaranteeing you survive, you'll likely be the first to get taken out. Now let's run a real test on this wick spike strategy to see if it's actually viable. For our 15-minute candlestick chart test, we'll define a wick as follows. The low wick must be at least twice the length of the body, while the upper wick must be shorter than the body. Additionally, the bodies of the current candlestick and the 2 previous ones should not be short or small. This aligns with the principle mentioned earlier. When there's consensus in price, there's no reason to get involved. The final conditions are that the overall trend must be downward before the wick appears, and the first candlestick after the wick must reverse upward. When all these conditions are met, we enter a long position. In backtesting over a year, although there were only 7 entry opportunities, the strategy achieved a solid 71% win rate with a risk-to-reward ratio of 1.2 to 1, which is quite impressive. This frequency actually aligns well with the approach of large capital players, who typically make moves infrequently. Finally, let's summarize candlestick interpretation. First, traditional patterns are more suitable for longer time frames. Second, if the candlestick body is short or the high-low range is narrow, it indicates strong price consensus during that period. High consensus means low volatility, so it's best to avoid entry. Third, every price within a candlestick is important, as each level contributes to the full picture. Fourth, if a wick spike occurs, it could signal that large capital is preparing for a move. If you decide to enter, align with the mindset of the big players. Alright, that wraps up today's introduction. We hope this helps you better understand how to interpret candlesticks. If you found our video helpful, please subscribe, like and share it with your friends.